Hi, Jeremy Harper here. Today I want to talk about the capital gains discount, the 50% CGT discount that you may have heard in the news, the origins and what that means for you. So back in 1985, the Hawke government introduced what you call the indexation rule. So what that meant for investors out there when we were trying to calculate the cost base, if you sold an asset to work out the tax payable on that transaction, they would index the cost base, which was tied in with the capital gain, or sorry, the CPI. So inflating the cost base over the years, depending on the length or the years held. Now, of course, that was a very complex calculation back then. Computers weren't common. So the government did a review back in 1999, and the Howard government introduced what you called the CGT discount, which was a flat 50% discount for any assets held greater than 12 months in your individual name. Now, we fast forward to today. And of course, there's different capital gains that are applied if you have an asset held in, say, a company or your superannuation fund. But talking about individuals, we are today looking at or listening to the government talking about removing that 50% discount only for property transactions. So, of course, that discount applies to the sale and disposal of any assets. That could be shares, it could be a company, it could be any other type of asset where you've made a taxable gain. But the government is signaling that they want to remove the 50% discount that would be applicable to property holders. So at this point, there's not a lot of detail. It has been pushed through some of the media as a bit of a talking point. And so what that means is what we've seen with the government is they're using that as a bit of a test the water to see what will be the feedback and the opinion of the public. But what that would mean is for property investors out there, if that's removed, in real terms, we don't have the indexation method anymore because that was too complex, which was deemed in back in 1999.